So it's January 2020 and you're starting to freak out because it's that time of year again. It's time to start thinking about filing your tax return. Hi, this is Todd Baker, your certified mortgage planner, and in this video I'm going to discuss the differences between standard deductions and itemized deductions. Now, I'm not a tax professional and therefore I cannot give tax advice. However, I am a mortgage professional and I do and am committed to passing along educational material to my clients, to my realtor partners, and to potential clients that might be watching this video. So we're going to go over standard versus itemized, and on the itemized, what portions you're allowed to deduct typically on your real estate assets, your primary home, and how and which documents to use, how to find those documents, and how to read those documents. So I think you'll find this very valuable. So the first thing to understand, under the new tax laws, the standard deduction, and what that means is it's an amount of money you get to just deduct off of your gross income. For singles people filing single is $12,000, and married filing jointly went up to $24,000. That's a very significant amount of money. So in helping you determine, do I want to just do my standard deduction versus do I want to itemize and include the deductions for my house, you needed to see like which one's going to give me more money. If you bought a house at a lower purchase price, meaning probably $200,000 and below, it might be the case that a standard deduction would just be easier to do and give you a better tax benefit. If you have a higher purchase price house, the opposite might be true, but that's sort of the benchmark. So when looking at your what's available to itemize, basically for itemization, there's certain medical expenses you can itemize. If your medical expense is over 7.5% of your adjusted gross income, there's also your mortgage interest on a primary residence, and how you determine what was paid is twofold. Number one, it's a 1098 you will get at the end of the year, and let me show you what that looks like. So you will get a 1098 from your mortgage company, and in box one, it'll show you the interest that's paid. The other thing is if you purchase real estate, the closing disclosure will also have on there some property taxes that you paid on that disclosure, along with some prepaid interest you paid. And let me show you what that looks like on a purchase. So here's an example of a closing disclosure on a purchase. And if you look down on page 2, you can see, like in this particular example, what was paid for prepaid interest. There's another $620 there, and then you had $1,800 in property taxes that were paid. Okay, now if you bought last year, you could have your closing disclosure and your 1098, and in some cases what happens is most mortgage companies fund the loan and then they're sold into what's called or transferred to a servicer. So you might even end up with two 1098s. But certainly to make sure you get all the interest, if you have your 1098, one or two of them, and plus your originating mortgage company should send you a 1098 that matches what's on your closing disclosure. But as long as you have the closing disclosure in your primary 1098, you should have everything covered. Now, if you refinance, it's the same thing. You're going to get a 1098 from your prior lender, right? Whoever the prior loan servicer. And then you're going to get a 1098 from your new loan servicer, and then you got to grab your closing disclosure. And same thing down on page 2. If you scroll down, you can see what was paid in property taxes, and right here under the prepaids, what was paid in prepaid interest. And that's important because you want to be able to gather all that interest. So the next deduction, it's called the SALT deduction, the state and local taxes, and that includes property taxes. It's now capped at up to $10,000 on a primary residence. So what you need to do is get a copy of your tax bill. And for many of you that have escrow accounts that are those in which your servicer just pays those, right? That's most of you. Then you may or may not have kept a copy of your tax bill. So let me show you how easy it is to go get a copy of your tax bill. Each county in the state of Texas has an appraisal district. So I used Collin County for an example, and many of them will also have a tax assessment office. Both of these will have the ability to locate your property and locate your property tax bill. And all you got to do is go to the property tax search, and then you put you scroll down, so you can put your last name, and then it'll pull up a whole bunch of properties. Now, one little trick here, if you do the property address, put just the street, like you can sort of see it's sort of highlighted there, just like it says example 250, put just the number right here, the street number, and then the street name. Do not include, you know, the avenue, boulevard, just street number, street name. It'll pull it up. You can download in PDF your property taxes, and then you simply take and you add together your mortgage interest on your 1098, your closing disclosure, and add that to your property taxes. And is that greater or less than your standard deduction? That'll give you a good idea. Now, there might be other tax advantages you have, so you need to do either one of two things. You should either be working with a tax preparer. Certainly, if you're self-employed or you have rental property, highly recommend working with a good tax preparer, because there's areas of the tax code you want to make sure that you're taking advantage of all of the benefits that you have available in terms of deductions and write-offs. TurboTax and other such places have great software for self-preparation. The big thing, and the reason for this video, is I highly encourage you is be a self-educated person. Think for yourself, right? That's why I'm doing this for you, giving you the information so you understand how it works. So if you're going to do it on your own, take the time to make sure you do a thorough job. If you're just a W-2 employee and you just basically have real simple, either you're going to itemize just your mortgage and property tax or standard deduction. But even if you're going to go to a tax preparer, that you could really ask those questions and make sure that if they send you a questionnaire, answer all of it, not just the mortgage. But if you have this stuff together, you're going to get the best possible situation in this upcoming tax year. Now, I'm available to help you with any questions at any time. What I do as a mortgage planner is I help people buy, sell real estate, refinance real estate. I take a different approach than most loan officers. Not only do I do the loan, but I'm going to look at your entire situation, make recommendations on cash flow, credit optimization, and wealth creation, and debt elimination. The idea is to live a financially free lifestyle and create memories for your family and be able to do all of that. That's what I help people do. If that sounds like a good model match for you and you're not an existing client already, give me a call. And for real estate agents, send me your clients. I will take great care of them for you. Have a wonderful day, and we'll talk soon.